When people hear the word bank, they normally envisage a specific brick and mortar structure somewhere in a shopping mall or in town, with staff available to assist your banking queries and tellers behind bulletproof glass to handle your money, be it deposits or drawings. There are currently three types of banks operating in South Africa. The first type of bank is called the Level 1 bank, or retail or conventional banks. The brands people normally envisage when they hear the word bank are Absa, Standard Bank, Nedbank, FNB or Capitec. These banks operate under the Banks Act and trade directly with the public. This is done from physical infrastructure in shopping centers and other main centers, and also includes online banking. These banks offer the public basic transactional services up to more sophisticated financial products. Theoretically, any entity can apply for a banking license, provided it has R500 million to start the licensing process and can comply with all the other licensing criteria. In practice, however, it is unlikely for a new entrant to succeed in getting a banking license for a Level 1 bank. The next category is called Level 2 banks or mutual banks. Mutual banks also operate under the Banks Act, but an entity is more likely to be granted a license for a mutual bank than for a Level 1 bank. It needs 30 million to apply for a license, plus a host of additional regulatory criteria. Current banks in South Africa operating as mutual banks are Finbond, VBS and GBS Bank. Then the category that we are interested in is called Level 3 banks, cooperative banks. A cooperative bank operates under the Cooperative Banks Act, and this was only signed into law in South Africa in 2008. Since then, the following three cooperative banks have been registered in South Africa. In 2011, the first two banks was Ditsobotla Primary Savings and Credit Cooperative Bank in Lichtenburg, with just over 1,200 members and over 7 million in assets. The second bank is known as OSK Coöperatiewe Bank Beperk, or better known as Orania, with just over 800 members and over 77 million in assets. The third and most recently registered cooperative bank is Zifa Kamisa Savings and Credit Cooperative SACCO. They were registered as a cooperative bank in 2017 with just over 600 members and a deposit of 4 million. To qualify to become a cooperative bank requires 200 plus registered and contributing members and deposits of more than 1 million. The stage before becoming a cooperative bank is called a cooperative financial institution, or CFI for short. The minimum qualification to be registered as a CFI is to have 200 or more registered and contributing members and 100,000 Rand in shareholders' funds. To be a member requires one to also own a share in the CFI. A CFI or cooperative bank is therefore co-owned by the members who are also the clients of the bank. The most critical requirement to be considered as a CFI is to have a proven common bond. Common bond means the cause or basis for the members to work together in the first place. Typical common bonds are location, like town or city, or people working for the same company, or belonging to the same church or trade union. Of the currently registered 28 CFIs, only 3 have a national license. GIG CFI is amongst these 3 based on its common bond of continuous adult education, mostly on financial literacy. GIG CFI was registered as a CFI in March 2015. The following diagram shows the comparative differences between a Level 1 or retail bank and a cooperative bank. Conventional banking, you are regulated by the Banks Act. Cooperative bank under the Cooperatives Bank Act. A retail bank is shareholder owned, whereas a cooperative bank is members owned. Conventional bank use fractional banking, whereas a cooperative bank is funded by the pooled savings of its members. Conventional banking can work directly with the public, doesn't need a common bond. Cooperative banking requires a common bond. A retail bank is shareholder profit driven, whereas a cooperative bank develops products and services that are member benefit driven. Therefore, conventional banking ends up charging high interest on loans with low interest on savings, whereas cooperative banking can allow low or no interest on loans and high interest on savings.